You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means we are back once again. It's time to talk some futures options. Yes, it is time for TWIFO. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the network upon which so many of you are binging. Hope you're having a good start to this wild year that is 2025. Man, I warned you at the end of last year. I said, lately, January comes in like a lion, not like a lamb, and it is certainly living up to that. We have a lot of fun to get to. Remember, if you like what you hear, this show, anything else we do, like a star, a comment, all that fun stuff does get aggregated together to help new people continue to discover the content. And there are new folks out there all the time. Help them beat a path to our door. And of course, if you want to beat a path to some intriguing additional content, head on over there to the Pro, theoptionsinsider.com/pro. Awesome Pro Q&As. Had another great one this week. Options oddities every Friday. Giveaways, fun times had by all over there in the Pro. Theoptionsinsider.com/pro is the place to go to learn more. As we learn who's joining us in the old CME Group hot seat today, I'm pleased to welcome back on for the first time in this mad, raging new year of 2025, our old pal, Mr. Kevin Green, the senior markets correspondent over there at the Schwab Network. Kevin, welcome back to TWIFO, sir.
Thank you for having me on, Mark, and enjoying these markets as we are seeing a little bit of volatility, a little bit of green on the screen here, especially in the commodity complex. So interesting start of the year. How are you doing?
I'm doing well. I don't care what Larry David says with his 3 or 7 day cutoff. I'm going to say Happy New Year to you, sir, because it's the first time I've talked to you this year. So Larry David be damned. We're going to have some fun here as we keep on rolling into a little bit of the old movers and shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, welcome to the Movers and Shakers, the portion of the show where we break down everything lighting it up to the light side and to the dark side over there at CME Group this week. And we're going to get to that. We're going to get there for this week as well, Kevin. But as I mentioned, this is your first time joining us after a rock'em sock'em robots year that was 2024. So let's start really quickly by looking back. When you look back at the mad year that was 2024 from a futures and indeed futures options perspective, sir, what really stands out and resonates to you?
Well, I think obviously the year was very dynamic, and I kind of wrote a piece a couple of weeks ago that no one knows what's going to happen for a year, and I think 2024 was a perfect example of that. We started off pretty strong on a relative basis when it came to the energy market, so we did see that kind of fade towards the remainder of the year. The China trade really didn't come to fruition here, and we just had some issues when it came to supply, a lot of gluts in certain areas of the market, and so we saw a little bit of compressed markets when it came to the energy complex, from oil to gasoline to heating oil. But on the other side of that, natural gas ended up the year pretty strong, and that was actually something that was not on a lot of people's radar. And then to start the year, obviously it is starting off a little bit strong here. And then the last area that I would say from a future standpoint was, let's talk about the index options. I mean, they did a phenomenal job when you're looking at the indexes across the board. And you're starting to see more of a pickup when it comes to the index options trading, some of the speculative trading here as we start to navigate the new Trump administration, some of the tariff policies, maybe some deregulation. So last year, great year if you're a commodities trader. You got to be very, very tight and tactical. And I think this year you're going to have to do the same when it comes to each and every one of these product offerings, from ags to livestock to grains to you name it. Everything is very dynamic right now over the first month and a half. That's what I suspect is going to happen here.
It is very dynamic indeed, and indeed continuing into this year. In fact, if you look at the movers and shakers report for this week, listeners, which you can find if you follow us over there at Options on Twitter. If you follow CME Group, they usually tend to tweet it out before the show as well. You'll see for this week, the bulls back in force. After taking a bit of a hiatus for the first couple of weeks of the year, the green is back dominating the screen pretty much across the board, pretty much across asset classes. I'd say, looking at this chart, listeners, we're roughly 70-30 green over red for the week. That said, we're roughly even in terms of size percentage movers on the week. Kevin, you are our guest. Think you can handle a little bit of light side and dark side for our listeners, sir?
Yeah, of course. Of course.
And you're the man, you're the guest this week, so you get to choose where do we begin our journey, to the light side or to the dark side, sir?
Let's start off with the dark side, and then we'll hit the light side here, because I think the light side is very interesting for a lot of commodities traders. So for the dark side, at number 5, we have lumber down 4.8% here for the week. We have at number 4, WTI crude down 4.94%. At number 3, we have heating oil down 5.38%. And then at number 2, we have palladium at down 6.3%, but that's actually a pretty interesting mover over the last 24 hours here. And then at number 1, we have natural gas down 7.89%. And on the light side, the reason why 5 is very interesting, the grains are really trying to lead the way here. At number 5, we have oats up 4.79%. At number 4, we have Kansas City wheat up 4.83%. We have Bitcoin up 5.19%. Soybeans breaking out up 5.52%. That's at number 2. And then number 1, we have soybean meal up 8.19% for the week so far here. So a lot of changes, a lot of bullishness when you're looking at the grains here, Mark.
Yeah, it's a wild week. You mentioned our old pal Nat Gas. That was definitely a frequent refrain last year. If I look back at last year, what resonates to me in 2024 on TWIFO was that Nat Gas was nigh on inescapable on the show week in, week out. It's just moving, but it's also delivering on the volume front. And it seems like it said, don't forget about me to kick off 2025 as well. It's our number 1 dark side mover this week. It was number 3 last week in the other direction, up nearly 11%. And it's been a banger start to the year for Nat Gas as well. Even factoring in this drop off this week, it is still the number 4 light side mover for the year in terms of the broad spectrum of all futures out there, listeners. It is only surpassed by Bitcoin. By the way, Nat Gas for the year up about 11.25% right now. A Bitcoin above it up about almost 12%, 11.94%, tied with palladium right around 11.95% for number 2, and the number 1 light side mover so far this year, soybean oil. So nat gas in rarefied air. I think this little Arctic blast may have a little thing or two to do with it. Snowing in Florida, snowing in Texas, not things we usually see. That usually means a little bit of love, even though this week not feeling the love for nat gas. But it is number 1 to the dark side. It is number 4 year to date. That means, listeners, we have to start in energy.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, listeners, let's do it. To the explosive realm of energy we go. Head on over to cmegroup.com/TWIFO, TWIFO. That will get you to our TWIFO reports that correspond with the program. You may have to sign up for a CME account. It takes like 2 minutes. Once you do that, you have access not just to our reports, but everything else they have cooking over there at CME. There's a lot of content, so be prepared. Probably going to go down some rabbit holes once you get over there, but make sure you're starting with our TWIFO reports. And then once you're there in that asset class drop down, go down 3 slots to energy. Then in product family, go down 3 more to nat gas, and you will see nat gas, like we said, having a bit of a rough week, giving back some this week, but still off to a banger start for the year, hanging out a little bit shy of the 4 handle in those very near dated front futures. That front future with 1 day to go is 391. I mean, 4 handle. That's wild out there in nat gas, listeners, are pretty close to it. What's also wild is the volume. This thing is not just moving, it is delivering on the volume front. 1.1 million contracts on the tape. Don't forget, this is a truncated holiday week. We were closed on Monday. So they're making up for lost time and then some. 1.1 million. There was a time not too long ago, listeners, this time of the week, nat gas would have a busy week. It put up 450, maybe 500,000 contracts. Wow, that was a wild week. We are far from those days, listeners. Nat gas is an untamed beast out there these days. Kevin, we were just talking about a wild year and indeed a wild start to this year for a nat gas. What's catching your eye out there this week, sir?
Yeah, look, for nat gas, just in general, obviously we had the Arctic blast that did take place, but usually when we have these weather premiums, if you're trading these type of products, you got to get in when the weather report comes out. So you can actually follow these weather events on NOAA, and that's usually where the market's really trying to price in what's going to happen. So we already had the run up in natural gas getting very close to that 4.4 handle, actually. And then now we're seeing it kind of pull back to the downside. I think it's because these weather events are going to subside. The issues that you're seeing at the ports, especially when you're looking at LNG export facilities, starting to give us a little bit of a signal that they're going to be able to ramp back up here when it comes to exports. Pipelines haven't been impacted as much outside of the Bakken region. We did see some forced flares as well as a little bit of slowdown when it comes to flows. But when we get to these price levels, it's actually been a little bit difficult to try to hold at these levels. And you can actually see that when it comes to the natural gas futures curve. So it's been a tough trade to short as of late, and we still kind of have this weather period over the next month and a half that could really kind of bring up a little bit of a spike when it comes to natural gas here. But I think this is also going to be a policy play for the Trump administration. Are we going to see approvals and a fast track for expanded LNG exports over the coming weeks and or months? Because that's going to make a big deal when it comes to Henry Hub over the next 2 to 3 years here, Mark. And if we do see the expansion of LNG, liquefied natural gas, and we do see the expansion of that infrastructure, Henry Hub probably will actually have a sustained move to the upside over time. And I think you are seeing a little bit of positioning for that optimism here.
Yeah, speaking of the positioning, this is just wild data to me here as I'm looking at the numbers. And again, listeners, you can see this for yourselves over there on the TWIFO report. We just had Derek Salmon from CME on the show last week. He kind of oversees a lot of these options products. And one of the trends he and I were talking about for last year was just the surprising adoption of near-dated paper in some products that maybe you would have thought a couple of years ago weren't that well suited to them. One of those was nat gas. A lot of people were saying a few years ago, I don't know if nat gas will ever go fully into the zero-day world the way equities and others have. It just seems like structurally a different type of flow in nat gas, a little bit longer term. And we are seeing kind of completely the opposite of that right now. Like I said, listeners, 1.1 million contracts on the tape in an already shortened week. Just Tuesday through Thursday right now is all we're talking about. 1.1 million contracts. And of that, Kevin, 33, almost 34% of it is going up in the Feb contract that expires in 5 days. So nat gas looking more like an equity these days, Kevin. It's all 0 day and short dated all the time. Does that surprise you, sir?
Not really. I mean, once again, you're seeing a significant amount of dynamic pricing on a day-by-day basis, right? I mean, natural gas is only down 0.15% today. This is actually a very interesting day because usually we've seen 8% swing to the upside on an intraday basis, or we're seeing a 4%, 5% move to the downside. So I think you're trying to get a lot of traders to catch those swings on an intraday basis. So it's not really surprising for me. What will be surprising is the volume once the contract actually gets a little bit depressed, right? Once we get closer to March, April, get closer to spring, get closer to injection season, that should actually put a little bit of pressure to the downside on prices. And then let's see if there's going to still be continued optimism to trade the product. But for now, with the Arctic blast that's taking place, with the new administration, I think you're just getting a lot of optimism, a lot of speculators in this market when it comes to natty, and rightfully so. It's probably the most volatile hard asset, hard commodity out there when you're looking at these futures products, hands down. You're already talking about 7% up for the year. I mean, we saw a 15, 20% move in a matter of week and a half before this Arctic blast took place. So this thing can be a mover. The zero DTE options, which are very, very risky, seems to be the thing that traders want to kind of get into in order to try to scalp on an intraday basis.
Yeah, nat gas is in a rarefied air of its own when it comes to vol. You're right. The only thing that can really even sniff it over there at CME, and it's not even a hard asset, it's Bitcoin and ETH. The crypto realm, exactly. They can both threaten the triple digits just like nat gas. But if you're talking hard assets you could hold in your hand, you're right. Nat gas is in, well, the gas itself, kind of hard to hold, but you could contain it. But that said, nat gas is kind of in a rarefied air from a vol perspective. Is that the case again this week? Well, as Kevin kind of mentioned, when it comes to these Arctic blasts and these weather events, it's kind of like any other event risk type trade. You kind of got to get in before the event risk happens, then get out. If you're doing it now, if you're trying to trade the Arctic blast now, kind of a little bit challenging as witnessed by some of these numbers out there. The vol coming cratering back to earth in these very near-dated contracts. It's only 5 days to go, listeners. They were trading about a 90, actually, vol, and then coming in 18 points just over the course of this week. So still a 70, still very frothy from a vol perspective. You can see why I say there's not much that can really touch nat gas from a vol perspective, with the exception of crypto. But a lot of that vol coming crashing back to earth. Again, if you wanted to trade this Arctic blast, kind of had to do it already, unless you're playing the vol fade as a result. Nonetheless, the skew out here is just looking wild, especially in these near-dated options. The calls last week, 9.1% bid. This week, nearly 15% bid. That's on top of an already juicy 70 at-the-money vol. So you're talking some serious juice to this upside, listeners. The puts, not so much. Nobody wants to touch a put right now. 6.6% cheap were the puts last week. This week, 10.5% cheap. So vol coming in, calls getting more bid, puts getting cheaper from a premium perspective. So kind of interesting out there. And in terms of action, what was the big dog out here this week? If you said puts, maybe the 3.5 puts going away in 5 days, you are the winner chicken dinner. 64, almost 65,000 of those going up. Again, just 3 days, listeners. That's, if you go look, that might be more than silver has put up all week right now in the entire complex. I mean, you're talking some serious numbers in nat gas right now. 65,000 of these 3.5 puts. The big day was Tuesday, 31,000, mostly opening there. 26,000 on Wednesday. Looks like some folks taking some off there. Today, only 7,100. Again, anyone's guess today with an OI of about 25,000 left on this strike. Exactly what they're up to out there. 3.5 strike, 5 days to go. Seems like it might be a bit of a bridge too far, but then again, if we can see this continued kind of pullback out there, then anything is fair game out here. I learned a long time ago not to second guess any prints, maybe some wild ones, but outside of those, not really second guess anything out here in nat gas land, including number 2. If that was a little bit too near dated for you, listeners, you said 5 days. I want a little bit more time for my trade to come to fruition. How about the March contract going out in 33 days? That's where we find our second most active contract in nat gas this week. This is a little bit farther out of the money. These are the 3 puts, 42,000 of those going up this week. By the way, once you get out of these very near-dated contracts, the contract expiring in 5 days, we see those futures come in a wee bit. And the March future, we're hanging out at a 343, so almost 50 cents below where those very near date, again, that curve looking very juicy, that front portion of the curve out there in nat gas. Understandably so. We're seeing some wild stuff going out there right now. But nonetheless, the March contract accounted for nearly 30% of the paper this week, about 28%, so no slouch itself. The calls out there are also bid, if slightly a little less bid than the Feb calls. The Feb calls are about 15% bid, pretty close to it, 14.6. The March call, still juicy, but 11.8% bid. That's up from 10.5% last week. The puts last week, 6.6% cheap. This week, nearly 12% cheap. So folks, slamming puts in March and in the contract going away in 5 days. Nobody wants them. By the way, the at-the-money vol in March, also a little bit calmer, a little bit saner, 58. That's down about 7 points this week. And that makes some sense. We're starting to get out of into the tail end, really, of the winter season at that point. The typically explosive, pun intended, season for nat gas. Obviously a very seasonal product. And the 3 puts, like we said, doing 42,000 contracts in March. Looks like folks were bailing on them all week long, and that skew number is kind of backing that up. Folks were just getting the heck out of Dodge on 3 puts all week, dumping about 15,000 on Tuesday, about 14,000 on Wednesday, and about 13,600 today. There's still 26,000 to go, so if they want to sell more, there's more to go. But right now, folks bailing on the 3 strike in March. So I don't know, Kevin, 3 half puts with about 5 days to go. That might be a bit of a bridge too far for just 5 days. What about blasting away on a bunch of 3 puts that expire in March? Does that excite you a little more?
A little bit. The thing with natural gas, once it starts to run to the downside, it's really hard to stop. So yeah, let's see, even those 3.5, it's kind of a little bit of a lotto. Let's say that if you are going long, but once again, anything is possible, and that's just kind of how this product works. At some point, when you kind of look at the technicals, and technicals on natty, it's really not that great to do. Sometimes you'll say, that can't be, that's way too far out of the money, and then you'll have a day where you get a 60-cent flush out of nowhere, and that's kind of how this product is. And that's usually how it trades once we get out of these weather events and we start getting a little bit better weather taking place. And the EIA report that we had today is kind of what you want to see if you're a bear in this market, where we had actually less of a draw than what the market was expecting. So that's really what you want to see if you have those 3.5s, or you have those 3s for next week, trying to get that report to give you some confidence that maybe this market could be knocked down and you get some shorts coming back in.
All right, let's keep it in energy here, listeners. Right behind it, hot on its heels, number 4 to the dark side this week, we have WTI off nearly 5%. Giving back some of its luster. It had a robust start to the year. Now giving back nearly 3 points just this week, just in this shortened holiday week, off 292 in that front future. So WTI still looking frothy at about 74.5, but obviously giving back nearly 3 points just since the start of the week. A lot coming off the tape, vol coming off the tape out here as well in WTI. Is that translating into a lot of paper? Are we seeing an explosion of paper like we're seeing in nat gas? The answer is no. Now, take this with a grain of salt as well. It is, again, a shortened holiday week, so all things considered, 450,000 contracts, that's about a normal week's worth of paper we'd expect up until Thursday anyway. So that's looking pretty good when you take 1 day out of that. It's still at 450, but it's just not nat gas. Nat gas putting up 1.1 million contracts and showing no signs of stopping anytime soon. So 74.5 of that, about 42% of the paper going up in the March contract has about 22 days to go. So we will hang our hat out there. Kevin, I know you watch WTI quite a bit. The last time you and I chatted on this show, I believe we were in the high 60s or low 70s in WTI, and you were talking about maybe if we broke through that 65 strike to the downside, it was going to be lookout below in WTI. Obviously, a very different paradigm, a very different market now that we're chatting a few months later. What's catching your eye out there in WTI this week, sir?
Yeah. So if you're kind of looking at it from a value standpoint, 67 to around 73, $74 is kind of your value area right now. There's nothing that's on the demand side that screams that oil should be trading at $80 or $85. And a lot of this run up that we've seen has been a short covering rally when it comes to the futures. And everything else has been supply side driven. I mean, if you're looking at the Russia sanctions, that's supply side, that's not really demand side there. If you're looking at the fact that refining rates and utilization rates tend to actually go lower the first couple of weeks in January. And we saw that with the EIA report today, actually. We saw a 5.5% drop in refining rates because of maintenance season. And a lot of these flows, once again, is supply side driven. So you did have that pop to the upside, $80, the key area of resistance. We are now kind of backing off of that. And Donald Trump's comments today around OPEC, basically asking OPEC to increase production and bring prices down, is another reason why we're seeing this 1.3% slide in oil here today. And that's really not bullish commentary here. So I think we kind of come back down, maybe hit 73, 72 and a half. And then that's where the decision is going to be made as to do you go long or do you go short? But until we hit a demand side catalyst for the bulls, the supply side shocks that we're seeing on an intermediate basis is just not going to hold prices. The weather event, once again, another key area where you had the Bakken region impacted to the north. You had the Eagle Ford and Permian Basin impacted when you're looking at Texas and production. Those are all short term, and that's where you're seeing this weather premium really backing off here. It's all got to be demand side in order for us to actually hit 80 and sustain 80. We don't have that right now, Mark.
Yeah, Trump rolling into office on the back of drill baby drill. That certainly poses some questions for the supply side of WTI going forward out here, listeners. And let's see if that's reflected in the paper. We're seeing, like we said, about 42% of the flow going up in the March contract out here this week. What is the volume? Might be asking in March WTI, about 27 and a quarter, coming in about 3 3/4 points. So vol coming in kind of across the board in the energy complex this week. Last week, we saw the puts were fairly bid, nearly 5% rich, 4.4% bid. That's pretty much gone. They're about 0.7% rich now, so all that bid is gone. Again, understandable. We kind of saw the downside move this week. So if you were loading up last week, you kind of got your move. Maybe you're getting the heck out of Dodge this week, or at least taking those puts off. And to the upside, we saw the calls were 1.7% cheap this week. They've swung to about equilibrium, a little bit positive, 1.2% bid. Anything really a point in either direction, listeners, I kind of consider flat from an overall skew perspective. And in terms of action, it was all calls in March lighting it up, but perhaps not the way you'd think. Looks like folks were getting the heck out of Dodge to the upside. In particular, it was the 80s. We know in the past, when we see a lot of upside in WTI that's opening, usually past its prologue, folks are loading up on that upside. It's kind of like a precious metal. Folks like to buy a lot of upside in WTI. So when they're bailing on it like they are this week, chances are they're probably taking some of that upside off. And that's kind of what we saw out here in the 80s. 19,000 of the March 80s going up. That's pretty much your number one print. And again, that's respectable for a shortened holiday week. Tuesday, 10,000 contracts on the tape. Again, all closing. 5,000 today against an OI of 25,000. Probably folks still hitting the exits there. 3,500 on Wednesday. So folks bailing there as well. Kevin, that kind of lines up with what you were saying. Until we see some sort of demand side really consolidating out here, it's kind of hard to make an argument for the 80 strike and above, which is probably why we're seeing folks hit the exits on these 80s in March. Would you agree, sir?
Yeah, I agree with you. And actually that aligns with what we're seeing with the commitment of traders. Look, if there's going to be a weather event, the producers usually will go long crude contracts because they may have a supply issue, right? Being able to deliver product or what have you, prices kind of move to the upside. If there's any type of force majeure situations that kind of take place, that's really their hedge. And I think right now that's exactly what you're seeing is kind of the unwinding of that hedge from the producers. And then obviously a lot of retail traders are kind of following suit. And then we'll come back down. And once again, 72 and a half seems like a value area where individuals might try to get back in and try to get a short-term bounce. But it's got to be demand side, and China is going to be that story. I don't think you're going to get the demand story coming from the United States right now. Where we're at for as far as gasoline consumption numbers has been pretty steady for the most part. So we got to look at our friends over in West Asia or East Asia, and hopefully they do see a bounce back with those stimulus measures, and that'll give us enough confidence to try to push this thing higher. But we're just not there yet.
Yeah, Saudi's announcing that big investment in the U.S. today as well. You got to have to imagine on the other side of that, probably some promises on the production side for crude. So it'll be interesting to see what we could see on the demand side to potentially offset that. I mentioned the last time you were on, Kevin, we were talking about that 65 strike being a very pivotal strike, at least for that moment in WTI. Well, it seems like somebody's listening to that older show, Kevin, because our number 2 most active contract in WTI this week is going out to June. So about 112 days, listeners. That future a little bit lower at about 72 3/4 right now. And somebody coming in looks like maybe scooping, maybe drawing a big line in the sand here on the 65 strike. If I had to guess, looks like maybe they're buying these. We saw about 12,500 of the June 65 puts going up this week. The lion's share of that in one big print on Tuesday. By the way, it's a shortened holiday week, listeners. So if I said Monday at all this week, you know I meant Tuesday. It always throws me for a loop whenever it's a shortened holiday week. But Tuesday, nearly 10,000 of that 12,500 going up, mostly opening on Tuesday. So somebody really had a bit of an axe to grind on these 65 puts on Tuesday. Another about 2,000 going up on Wednesday. Only about 800 today against an OI of 21,000. The skew kind of reflecting that as well. They're about 4.2% bid. This week, 6% rich. So I don't know, Kevin, I know 65 is a strike you were looking at before. 65 in June, is this a strike that still intrigues you? And also, if you had to put on something, would you be a buyer of these 65 puts, given what you were saying earlier? If we start threatening that strike, is it really going to be look out below again, you think?
I think we'll probably defend that level. We have in the past, and I think that we'll probably defend it as much as possible. I think the flush below 65 would have to also coincide with weak economic data here in the United States, and so it's something that you could take a shot on, but I don't think we're at that level yet when it comes to the economic data either. But if we were to see a break there, I do believe that you'll probably see a domino effect. And history kind of shows us that usually when we break that 60, 65 level, we actually do see prices kind of going down to around 40, 45 bucks. So that's something that you don't want to see. And that also kind of coincides with equities selling off, that economic data kind of gets worse. We're not there yet, but if we were to get there, that's something that kind of keep on your radar here. So if you were kind of looking at it and you wanted that downside shot, not a recommendation, but you probably would look at more of a 65, 60 put spread to kind of offset some of that theta decay just in case it does not happen. And then you still get a little bit of a lotto. And if it gets close to at the money or in the money, you could take it off. Maybe not even trying to see the follow through, but as soon as it kind of gets approaching 65, that's probably where you want to try to cut loose with it, just because there probably will be a significant amount of buying pressure there, just on old habits alone. I like
that vertical a lot better than the straight up 65s. Kevin, we've been gassing on, pun intended, about energy for a while. We probably got time for one more product. Where should we go next, sir?
Let's hit grains, because they are catching a bid.
All right, to the wonderful world of grains we go, listeners.
It's time to get our hands dirty exploring the latest options, trades, and trends in corn, wheat, soybeans, and more. It's time to talk ags.
All right, listeners, to the ags we go. Easy to find in our drop-down. Let's go right to the top of the alpha order list, ags right there. Then we're going to go to grains and oil seeds, listeners. And then from there, it's dealer's choice. I have a feeling, Kevin, you were talking earlier about soybeans number 2 this week, up 5.5%, and soybean meal up 8.19%, our number 1 light side mover. I got a feeling you want to start in soybeans. Kevin, what's catching your eye out there this week?
Well, for the soybean complex and also for corn, but for soybean, it's actually trading at a very interesting level. We're sitting at around 1064 right now. But this has been an area of resistance, and it looks like it wants to try to break out. And the reason why I kind of bring this up, corn has already officially broken out over the last couple of trading sessions here, and you are getting a lot of enthusiasm for soybeans. And there's a couple of different factors that are taking place. You had the USDA supply demand report about a week ago or 2 weeks ago. I'm losing track of time myself with all these holidays and stuff. But we had that report, and they actually had a lower than expected number when it came to 2024, 2025 ending inventory or ending stock, if you will. So that's really what kind of started the pricing pressure to the upside. And then we had the tariff policy or lack of tariff policy coming out for the inauguration for the new administration, and then also maybe lower numbers than we expected for China tariffs, 10% rather than 60% that was being stated on the campaign here. And we started seeing the dollar kind of move back to the downside. That actually could increase export demand for soybeans and also for corn. And the last thing as well, there is a little bit of a pest problem in Brazil's exports, and China's not too happy about that. And if they are not going to be up to snuff when it comes to their product, China could also be increasing their imports from the United States. And once again, another reason why we have a bid here. So technical potential breakout level here. You got the fundamentals that are kind of in place that are saying, hey, there could be more room to run to the upside. And I think that's why you're seeing this product move. And I'm sure the options paper's probably reflecting the same.
Let's see what we're finding out here in good old soybeans, listeners. And is it a hot week? Yeah, it's a banger. This is one of the hotter weeks we've seen in soybeans in some time from an overall volume perspective. I just said WTI struggling to put up 450,000 contract, which is an average week's worth of paper. Soybeans average week a lot less than that, but putting up 455,000 contracts as well. On top of that, it's a shortened holiday week, so this is definitely a banger out here in the beans. Of that, 35.6% going up in the March contract has about 29 days to go, listeners. You might be saying to yourself, what is the 30-day vol out here in soybeans? And the answer is it's about a 19 and a quarter, kind of unched actually, weirdly enough, in that 30-day time frame. If you get a little bit beyond that, we're hanging out anywhere from about a 20 to looks like about an 18 or so. So interesting range on the vol side. Skew-wise, given the move, by the way, soybeans right now, 1064, up about 30 handles or about 3%. Again, just since the start of the sessions on Tuesday. You go back to our show last week, obviously up a lot more than that. Skew-wise, not really lighting the world on fire, which is kind of interesting. Only 2.2% bid were the calls last week, 1.6% bid this week, even though it was the 1100s that were leading the dance this week. I said we're at a 1064 right now, listeners. 1100s putting up nearly 20,000 contracts. About 9,000 on Tuesday, mostly opening. 6,200 today against an OI of about 22,000. 4,500 on Wednesday, slightly closing there. So that was the big dog. Par puts also putting up some paper in March as well, about 15, almost 16,000. Seems like folks are bailing on those, and the skew kind of reflects that. The skew is kind of unched last week and this week, kind of flat both weeks. So interesting, about 16,000 going up. 6,000 each Tuesday and Wednesday, 3,400 today. Looks like mostly closing throughout the week. So folks bailing on the downside to the puts, buying some 1100s. I did say the skew is not that abnormal. I take that back for one for 1 week. The contract ends of July, going out 182 days. It's showing a 41% bid to the calls last week, and then about a 12% discount to the puts. That seems a little wild. Might be a bit of an aberrant print. It's only 3.5% bid now, but still. Some wild stuff going up out there. You also mentioned corn. Let's go there really quickly before we got to run out of here for this week. We haven't had a chance to talk about corn that much, listeners. Corn right now, 489.5, up about 5.25, about 1%. 552,000 contracts on the tape this week, so a hot week in the ags from a volume perspective. About 29 days to go for the March contract. That's where we're hanging out in the 5 calls, listeners. Yes, the 500 calls, doing about 36,000 contracts on the tape here, listeners. Let's see. The big day for these is today. About 17,000 going up today against an OI of about 28,000. 14,000 on Monday, mostly closing. 5,600 on Wednesday. Opening on Tuesday, and then slightly closing 5,600 on Wednesday. So back and forth paper on these pars, these 500 calls, which again, we're at 49.5. So we're threatening that strike. It makes some sense. Skew-wise out here in March, 5.1% bid were the calls last week. Coming in down to 2.1% bid now. The puts last week, 3.7% discounted this week. roughly the same level, about 3.2% discounted. So not a huge skew evolution. Seems like we got a little bit of upside. Some of that bid for the calls coming in, which makes some sense. And we also had some back and forth paper on the 500s. Kevin, March 500s, 30 days to go. Are you a fan of those out there in corn, sir?
Yeah, I mean, just from a technical standpoint, it does make sense. I mean, if you go back and look at a weekly chart, that was an area of resistance that we saw back in October of 2023, and then kind of once again back in December of 2023. So we haven't really seen these levels in over a year. So now you're seeing a short covering event. I already talked about the fundamentals that have taken place here. It might be a big area of resistance, but we've already broken out of this, descending triangle type of formation here. And I like to marry the technicals with the fundamentals here. And it just says that 500 seems to be either that area of resistance or that breakout point where we can continue to move higher. And if you do see a breakout, I mean, you're talking about 572.5, Mark, and that's a decent run. I mean, corn's up around 8.7% year to date, give or take. So this is actually a really nice run. It gives maybe some of these ag bulls some more confidence here that it might be their time to shine after the last couple of years of depressed price.
If that move comes to pass, those par calls are looking pretty good, Kevin. Might want to all scoop some of those pars going out in the March list. Unfortunately, that music means we're out of time for TWIFO this week. Kevin, I was going to ask you for your VIX end of year prediction so you could play along in our game, but I see we already have one for you. 1785, so good luck to you. That's pretty close, about half a point from where we closed this past year. So, and kind of in line with our audience. Our audience is actually feeling more. About a third of them said they expect to close north of 20 this year. So they're feeling a spicy end to the year from a vol perspective. You're not that far behind over there at 1785, so good luck to you. And before we go, Kevin, if folks want to check out what you have cooking on Schwab or anywhere else, where should they go? What should they do, sir?
Yeah, you can follow me on X or Twitter at KG Bull and Bear. You can also follow me on LinkedIn. Just type in my name, Kevin Green, and Schwab, and then you can find me there. I write articles pretty much every week. I did do a little bit of a Q1 high-level, I don't want to say outlook, but market view, if you will. And I will say, I got to toot my own horn. We were talking about copper, we were talking about LNG, and a lot of those moves have been pretty sustainable to the upside. Seeing a little bit of a pullback there, but if you want to check out that report, it's definitely free. You can look at that on those platforms. So, Mark, I always appreciate being on. Happy New Year to you as well. I hope we see a very profitable year for not only yourself, myself, but also those that are listening.
Well, thank you for that, sir. We'll be sure to check out all of those reports. Hey, feel free to toot away. Toot that horn, sir. That's what it's for. At the end of the day, check out Kevin over there on all the outlets he mentioned, including over there on Schwab. While you're checking stuff out, make sure you check out the TWIFO reports, cmegroup.com/TWIFO. That's really just the tip of the iceberg. Once you're there, you can get all the other tools, FedWatch, the C-Vol, you name it. A lot of great educational content, research from Blue and the team over there. It's quite the rabbit hole over there at CME Group, but make sure you start your journey, cmegroup.com/TWIFO. That's going to do it for us on the network today. Back again tomorrow, noon Central, 1 p.m. Eastern, to talk all things vol on VolView. Should be a fun time. Who's going to join me on the show? Got to tune in to find out. Then we're back one final time for the week, exclusively for the cool kids hanging out in the Secret Club. We talk a whole bunch of wild paper. It's been wild lately on oddities. The quantum strangles, just wild paper for days. What will happen on oddities? You got to tune in to find out. TheOptionsInsider.com/pro is the place to go to learn more. And we're back again next week. I think we're at a full trading week next week. We've been off a lot lately, so a full trading week next week. That means we'll be back again next Thursday, another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.